All right, let's dive into a really fascinating day in the market. A day that was, well, completely split down the middle. It was truly a tale of two different economies clashing at the same time. Let's break it down. So the day was Wednesday, November 12th, 2025. And what made it so interesting is that the market was being pulled in two totally opposite directions. It really gave us this perfect snapshot of the major conflict that investors are wrestling with right now. And here is that conflict in a nutshell. On one hand, you had the Dow Jones hitting a brand new all-time record high. I mean, that signals incredible strength, right? But on the very same day, we got news that defaults on subprime auto loans hit their highest level in 30 years. That's a huge red flag coming from the most financially vulnerable consumers. This is the central tension we're going to unpack today. So let's look at how the day officially ended. The Dow, as we said, surged to that new record. The S&P 500 basically finished flat, but it did manage its fourth day in a row of gains, which is something. But look at the Nasdaq. The tech-heavy index actually went down. This is what you call a classic mixed market, where just looking at the big numbers really doesn't tell you the whole story. So what was the big engine pushing the positive side of the market? It really all boils down to one thing, just this massive, incredible wave of optimism about the future of artificial intelligence. You could think of this as the locomotive just charging full steam ahead.
And what was slamming on the brakes? Well, it was a really clear, flashing red light telling us that the average, everyday consumer is starting to get into serious financial trouble. This is the big worry, you know? It's like the AI locomotive is speeding along, but the tracks it's running on are starting to crack.
Okay, so let's start with that positive force. Let's talk about the AI growth engine, and specifically how one company came out with a forecast so huge it sent shockwaves through the entire market. You know, this quote from AMD's CEO, Lisa Su, just perfectly captures the feeling in the tech world right now. There's this sense that all the billions and billions being poured into AI, it's not a reckless bet, it's the necessary bet on a future that's going to change everything. And this is the number that just blew everyone away. AMD came out and projected that the market for just AI chips, not even the whole industry, just the chips, will be worth $1 trillion by 2030. No, that is not a typo, $1 trillion. The sheer scale of that number just completely reignited investor excitement. And, you know, it wasn't just some big, far-off number. AMD really backed it up with some incredibly aggressive specifics. They're telling investors to expect, on average, 35% revenue growth every single year for the next few years. And get this, 80% annual growth in their AI data center business? It's no surprise that Wall Street analysts at places like Wells Fargo and UBS were literally scrambling to upgrade their price targets for the stock. So that's the powerful engine pushing everything forward. Now let's flip to the other side of the story. Let's talk about the warning signs that are applying the brakes and creating a lot of anxiety. And this number is the heart of the problem, 6.65%. That's the percentage of subprime auto loans that are delinquent, meaning people are more than 60 days late on their car payments. To see that number hit a 30-year high, well, that is a major, major red flag for the health of the consumer.
You know, there's actually a name for this phenomenon. It's called a K-shaped economy. Just picture the letter K. The top arm is shooting up and to the right. That's the AI sector, high-income earners, they're doing great. But the bottom leg is heading down, and that represents lower-income consumers. This auto loan data is probably the hardest proof we've seen of that split.
And it wasn't just the struggling consumer either. There were other big problems brewing. Because of a government shutdown, we were facing a data blackout. We might not get the official inflation or jobs numbers, and that means the Federal Reserve is basically driving in the fog, trying to decide what to do with interest rates. On top of all that, oil prices suddenly plunged, which hammered the energy sector. It was just this perfect storm of uncertainty. So what happens when you have these two powerful competing forces, this AI rocket ship on one side and these economic brakes on the other? Well, investors start moving their money around. They start selling what they suddenly see as too risky and buying what they think is safer. This is called a great rotation, and it creates some very clear winners and losers on the day. And you can see that rotation happening right here. Money was flowing into what are considered more defensive, stable sectors like healthcare. It was the top performer. Financials did pretty well too. But then look all the way to the right at energy. It got slammed, down almost 1.5%, thanks to that big drop in oil prices. And you can see this split even more clearly when you look at individual stocks. Of course, AMD surged 9% on its amazing AI forecast. The sneaker company On Holding soared after a great earnings report, which shows some consumers are still willing to spend on premium brands. But then, on the flip side, Oracle dropped because investors got worried about all the debt it's taking on for its AI plans, and the crypto firm Circle plunged on fears of new competition. It really was a market cut in two.
So if you're an investor trying to make sense of all this, how do you even begin to navigate it? Well, based on everything we saw, you can really see three different paths forward. And it all depends on your personal outlook and how much risk you're willing to take.
So, we've got the aggressive path, which is basically doubling down on the AI boom. Then there's a more stable path, which is about riding that rotation into safer areas. And finally, there's the defensive path for people who are really worried about the economy as a whole. Okay, first, the aggressive path. This is a bet that, really, the AI story is the only story that matters right now. The strategy would be to invest directly in the companies building all that AI infrastructure, like the chip makers. The risk here is pretty obvious, right? What if this all turns out to be a bubble? Or what if we hit a real-world wall, like literally not having enough electricity to power all these new data centers?
Second, we have the stable path. This strategy basically says, okay, I see this rotation happening, and I want to be on the winning side of it. So you'd invest in those sectors money is flowing into, like healthcare. The idea is to find solid value in places the market might have overlooked. The risk? If those consumer problems get a lot worse, they could pull the entire economy down, not just the high-flying tech stocks.
And finally, there's the defensive path. This approach says the warning signs are just too serious to ignore. The strategy here is to seek safety in high-quality government bonds. The logic is, if the economy really slows down, the Fed will probably have to cut interest rates, and that would make the price of these bonds go up. The main risk here is if inflation stays stubbornly high, which would stop the Fed from being able to cut rates.
Okay, we have covered a ton of ground here, so let's boil it all down. What's the final takeaway? What are the two most critical things that you need to be watching from here on out?
It really all comes down to these two huge questions. First, is the AI boom for real and sustainable, or is it just a massive bubble that's waiting to pop? We need to see if these trillion-dollar predictions actually turn into real, lasting profits. And second, does the consumer crack? We have to watch carefully to see if the stress we're seeing in auto loans starts to spread to things like credit cards and mortgages, because that could trigger a much wider recession.
And that really leads us to the final, big-picture question that perfectly sums up where the market is today. You've got this incredibly powerful AI locomotive pushing forward with what feels like unstoppable momentum. But it's running on a track that is showing very clear signs of stress and cracking under the pressure. So the billion-dollar question for every single investor right now is pretty simple. Which one wins?